World Development Report 2014. Risk and Opportunity. Chile's Innovative Fiscal Policy with Andres Valesca, Professor of Professional Practice and International Development, Columbia University.
As the finance minister of Chile between 2006 and 2010, I had to deal with an age-old problem of countries like Chile, the volatility of fiscal revenues in the context of an economy that is very open and very dependent on exports of natural resources, particularly copper. Chile is a middle-income country. We earn a living in the world economy exporting, and a good deal of fiscal revenues are linked either directly or indirectly to copper. So there is a problem that Chile faces and that many other commodity exporters face. There's a tendency for revenues to fluctuate and for expenditures to fluctuate along with revenues. And this is, of course, bad because it introduces an element of instability into public expenditure, social expenditure, and particularly public investment. Some countries have an even bigger problem, which is that expenditure becomes very heavily pro-cyclical, sometimes oscillating even more than revenues. That is to say, when, for instance, the copper price is high, in addition, the country has access to world capital markets, it is easier to borrow. So if you earn 10% more from copper revenues, you spend 15 or 20% more. And this is an age-old problem in many emerging countries, Chile included. Beginning in 2001, Chile began to take measures, build rules, and build institutions to deal with this problem. And the progress came in two stages. First, in 2001, and during the presidency of Ricardo Lagos, the country developed a fiscal rule based on the idea of targeting long-term expenditures and linking them to long-term or structural income. And the idea was very simple. You come up with an estimate of what the long-term income of the government is, and you set expenditures to be more or less equal to income. And I say more or less because at the very beginning, we were targeting a small fiscal surplus of 1% of GDP. That is to say, the rule was designed for the government to spend 1% of GDP less than long-term income. This rule had many benefits. The obvious benefit is that it stabilizes expenditure, and in particular it stabilizes social expenditure and public investment, and makes it more independent from the fluctuations of the local economy and also the fluctuations in the world price of copper and other commodities. From a practical point of view, the challenge is to have unbiased independent estimates of what the long-term price of copper is and what the long-term prospects for economic growth in the country are. How did we do that? Well, we appointed committees of experts independent from the government who every July come together. There's a group of 15 who focus on copper prices, 15 who focus on long-term growth, and they come up with estimates. We average the estimates, we use them as inputs into a fairly complicated formula, and voila, we have an estimate for long-term or structural income. And on the basis of that, you target expenditure. In addition, this rule had beneficial impacts on the policy and political process, because the life of a finance minister is much easier if you can say to your fellow members of the cabinet and to members of Congress, look, let us have a discussion about the composition of expenditure, but within a preset ceiling. The focus of the process changes entirely, the political economy of the process changes entirely. And this began happening in 2001 and had been going on for 5 years when I became finance minister in 2006. At that point, we decided to make two additional changes to strengthen and deepen this process of institution building and rule building. The first thing that we did was we took this rule, which had been self-imposed by the previous administration, and built it into the law. We went to Congress and we said we would like legal authority to institute this rule and make it legally binding. The government still has a fair bit of freedom in that the government decides on what the target is. But once the target has been set by the government has to explain, and it is legally bound to do so to the Congress, how it is that it plans to fulfill the target. And this again has a beneficial impact in that it changes the dynamics of policy making and also the dynamics of political negotiation. That was change number one. Change number two had to do with building institutions to deal with the savings accumulated as a result of the application of this policy. I should say that particularly in the years in which the price of copper went up, Chile was running fairly large fiscal surpluses of about 3% of GDP in the previous administration, and those surpluses in the years 2007, 2008, before the crisis, reached as high as 8% of GDP. So the question was, well, what do we do with the resulting savings? You couldn't simply leave the money lying around. It could be spent, or you couldn't quite be sure that you could say to taxpayers, look, your money is being invested properly. So we took all the precautions, and again, what did we do? We built an institution. The Congress gave the government authority to set up 2 sovereign wealth funds, and we set up 2 because they had different time objectives. One is a pension reserve fund, and it is aimed at the long term, and the rule dictates that every year the government has to deposit in the fund 0.5% of GDP arising from any fiscal surplus. In addition, we set up another fund which receives the proceeds of any fiscal surplus that exceeds 1% of GDP, and we call that the Economic and Social Stabilization Fund. Precisely because we were running fairly large surpluses, a fair bit of money was deposited in these funds. And by the time the world crisis erupted in 2008, we had saved in both funds slightly over $20 billion. At the time, the Chilean economy had a GDP of roughly $200 billion. That is to say, we had saved about 10% of GDP in very liquid assets. And this is important also to highlight. We chose a very safe and very liquid portfolio for the investments. First of all, because we could see that the world economy was entering a difficult process, but also because we wanted to have very low risk. The system was new, the system had to become known and understood by citizens, and the last thing we wanted was a big drop in the value of these savings. These public savings and this fiscal discipline came in very handy when the world crisis erupted. Chile was very heavily hit by first the financial meltdown linked to the collapse of Lehman Brothers, and also by the very sharp slowdown in world trade and world economic activity that followed. To give you one number that illustrates the size of the shock, between the first semester of 2009 compared to the first semester in 2008, the value of Chilean merchandise exports fell by 40%, 4-0. That is to say, the trade shock, the real shock, was tremendous. Add to that a certain loss of market access by Chilean banks and Chilean companies who before had been tapping into world capital markets, and the net effect is that of a tremendous real and financial shock. What was Chile in a position, what we're in a position to do at that point? Well, we had very low public debt. At that time, Chilean gross public debt was less than 5% of GDP, and Chilean net public debt was negative. That is to say, the government was a net creditor. That meant that we had no or very few credibility problems as to the fiscal stance. And that also meant that very early in 2009, the government was in a position to launch an aggressive anti-crisis fiscal package of about 3 points of GDP. In that package, we announced an increase in certain kinds of expenditure, particularly public works and transfers to poor households. In addition, we announced certain temporary tax cuts aimed particularly at small businesses that were having liquidity problems. And finally, we destined $1 billion to a capitalization of Codelco, the state copper company and the world's largest copper producer. Codelco had lost market access, they couldn't borrow in international markets, and therefore they couldn't have been investing unless the owner, that is to say the government, had given them the money, and we in fact did give them, as I said, $1 billion. In addition to this very aggressive counter-cyclical fiscal policy, the Central Bank of Chile, which is an autonomous entity with pretty high anti-inflation credibility, went in for a very sharp process of interest rate cuts. In less than a semester, the short interest rate went from 7% to 1%, and the combination of an aggressive fiscal policy and an aggressive monetary policy was able to contain the real effects of the shock pretty quickly. Chile did have a recession, but it was a fairly mild recession. We had 3 quarters of slightly negative growth. In calendar year 2009, GDP contracted, but by only 1% of GDP. Unemployment rose, but it was contained below 10%. And after those 3 quarters, by the end of 2009, the economy had begun to grow again, and it has been growing ever since. So the conclusion is that having done the homework before the crisis, having paid back debt, having accumulated assets, having created institutions, rules, and therefore credibility, put Chile in a very strong position to deal with what was a tremendous real and financial shock.